So, like, we agreed that loan can be seen as a financial instrument. Loan can be classified as a financial instrument. Okay, loan can be classified as a financial instrument because is going to give the holder a right to contractual cash flow. The person will be receiving a cash flow in a form of interest at the end of every year, and the person will receive the final payment of the loan at the end of the period or the maturity period. Or the person is going to be receiving the cash flow, which will cover both the loan, the principal payment, and then the interest payment. So you are going to receive a cash flow. So any instrument that is giving the right to a cash flow or annual cash flow or quarterly cash flow, that particular instrument can be classified as a financial instrument. Okay. You see, there are certain times that maybe related parties or companies under the same group or a parent, a parent might be giving out a loan to a subsidiary. Okay, a parent might be giving out a loan to subsidiary. At the group level, that will not be classified as a loan. At the group level, that will not be classified as a loan. But in the individual books, it will be classified as a loan. But we are not here to talk about that. We want to talk about a loan given to what? An independent third party. An independent third party. So what will happen is that sometimes you can see that a bank or a government entity may give a loan to what? To a company. What normally happens is that when a loan is given out, the loan will be given out at a rate lower than what? The normal interest rates. So the government of Ghana, do we even have money to give to the companies? So let's use the government of UK. Okay. So let's look at government of UK. Okay. So the government of UK may decide to what? Help entities. So what they will do is that they can give a loan of £100. Okay, they can give a loan of £100 to what? To companies, but this loan will be given at what we call a subsidized rate. So if this loan should be given to the company by a bank, maybe the interest rate will be 5%. But for that of the government, they are now giving them at a subsidized rate of 3%. Okay. What it means is that if it should be an independent third party, like maybe a bank or a commercial entity that is giving their loan, it will be 5%. But for government, it's 3%. The question is, how would the entity that is receiving the loan should account for this particular loan? At what rate? At what rate? At what rate should they account for this particular loan? That is what we are going to look at. That's what we are going to look at. Okay. So what we do is that the loan is given to you at 3%. The loan should be given to you at 5%. That is the actual interest rate. That is the actual interest rate. That is the actual interest rate. But they are giving it to you at a subsidized rate. They are giving it to you at a subsidized rate. What we do is that we use the actual interest rate to account for what? The loan. So the assumption is that the loan is at 5%, but because of the relationship between you and the person, that is what the person is giving it to you at 3%. So the loan should be accounted for at the fair value, at the date, the initial recognition of this particular loan. Initial recognition of this particular loan. So you just account for the loan as if you are taking it from what? A commercial entity like the bank, which will be given to you at 5%. So initial recognition, the loan will be accounted for at fair value. What do we mean by the fair value? The fair value will be the present value, will be the present value of all the cash flows using the what? The actual interest rate, which is the market's interest rate. So the present value of all the cash flows, present value of all the cash flows, all the cash flows that will be paid or that will be received under the loan. So all the cash flows using the market interest rate, using the market interest rate as a discount factor. So the cash flows will be discounted at the what? At the current market interest rate, which is the 5%. So the assumption is that the loan should have been given to you at 5%. So all the payment that you'll be making should be on 5%. But just that because of the relationship, because it's a government loan, that is why they are giving it to you at a subsidized rate. So what will you do is that this will now be the effective interest rate, and this will be the coupon rate. So the 3% will be the coupon rate, and the 5% will be the effective interest rate. So using the market interest rate. So you discount all the cash flows. What will be the cash flows? You'll be paying the interest of 3% every year to the number of what? The years that the loan will be paid back. So the 3% of the nominal value, which is a cash flow, which will be the interest, okay, nominal value. Then maybe you look at the repayment of the loan at the maturity date. So the repayment of the loan. So the cash flows will include the 3% interest on the nominal rate, which is the nominal interest, which is the coupon. Okay, so how many years are we going to pay the coupon? We calculate it and discount it using the 5%. Okay, then we come to the repayment of the loan. So the repayment of the loan, maybe they will say that the company will pay all the £100 at the end of 5 years. So that £100 will also be what? A cash flow under the loan. So what I'm trying to say is that they can give you a question where the company will be giving a loan to another company at a subsidized rate. The subsidized rate is just because of relationship between the company. That's why they are giving it to them. But under commercial terms, the loan should be given at the current market interest rate. So we use the current market interest rate to discount the cash flows under the loan initially and compare with the amount given. So there will be a loss. We are going to get a loss under this particular one. But that is not the issue here. We go there, we are going to get to that particular side. So the standard says that when a loan is given, or when a company give out a loan at a subsidized rate, the loan, which is a financial asset or financial liability, should be initially recognized at fair value. What constitutes the fair value is the present value of all the cash flows discounted using the current market interest rates. That is, you account for it as if the transaction is between two independent what? Parties. All right. After this, maybe it can happen that the present value is 95. The present value is 95. Okay. But the loan that was given was the value of the loan given was £100. Was £100. So let's use the dollar sign for now. So it was 100. All right. But the fair value at that date is what? 95. And the value given was 100. What will happen is that there is what? If it is the person who is giving out the loan, if it is the person accounting for this, the person will classify this as a financial asset. But if the person receiving, if it is a company that is doing this computation, then they are going to classify this particular loan as a financial liability. Okay, so you can see that if it is a financial asset, the company is going to incur a loss of what? 5, which will be charged to profit or loss. So the financial assets should be recognized initially at 95, though they are given 100 out. Okay, so the double entry will be the company will debit financial assets with 95, debit profit or loss 5, then they will credit cash or bank because they are giving 100 out. But because of the arrangement, they have to account for the financial asset at fair value. Okay, if it is a financial liability, if it is a financial liability, what will happen is that the company is going to recognize again because I should be paying you 100 cedis, but they're now saying that it's 95. So it means that I'm realizing a gain of 5. So that 5 should go to profit or loss. So it will be they will debit their cash because they are going to receive 100. Then they will credit their financial liability with 95. And they will credit their profit or loss as a gain with 5. Okay, that is how they are going to do it. But subsequently, what will happen is that this particular loan, if it is a financial liability, it should be carried out through amortized cost. How do we call the amortized cost? You calculate the interest on the net amount, which is 95. Then you calculate your coupon and take it. Then you find the difference. If it's a financial asset, it depends. If it is a loan, the classification will be 3. If the company is using profit or loss, you know how to account for that. If it is other comprehensive income, you know how to account for that. If it is amortized cost, you know how to account for that. So the classification will be given in a question. So this is what the standard says about subsidized loans. Loan given at a subsidized rate. It should be initially measured at fair value. What constitutes the fair value? It is the present value of all the cash flow discounted using the current market interest rate. Without wasting much time, let's pick one question on this one. Then we move on to impairment of assets. Impairment of financial assets. All right. So let's look at question 5 here. Santa C made a loan of 50 million to a charitable organization. Sometimes they call it charitable loans. But it will not be given to only the charitable organizations. Government can also give it to companies as a way of supporting them, where the loan will be given to them at a subsidized rate. Or development banks, maybe agricultural development banks, can also give that particular loan to companies at a subsidized rate. It's a way of helping them to boost their operations. Okay. Or mostly can be given to companies that are struggling to come back to their good old days. They can give a loan at a subsidized rate to them to motivate them or to enable them come back to their normal good days. So let's look at the question 5. Someone should take the question 5 for us. Senior Augustine, are you that busy? Take the question.
Okay. Santasi has made a loan of 50 million CD to a charitable organization for the building of new sporting facility. The loan was made on 1st June 20X2 and is repayable on maturity in 3 years' time. The interest rate on the loan is 3%, but Santasi assesses that an unsubsidized rate for such a loan would have been 6%. The first interest payment was made on 31st May 20X3. Santasi initially recorded a financial asset on 50 million and reduced this by the interest received during the period. The loss allowance has been correctly dealt with. Required. Discuss a suitable workings how the loan to the charitable organization should be dealt with in the financial statement of Santasi for the year ended 31st May 20X3.
Okay, thank you. So from this side, from this question, you can see that the loan was given at an interest rate of what? 3%.
3%.
Okay, but if this loan should be given by a commercial what? Entity, it should have been what? 6%, isn't it?
Yes.
All right. Who is giving the loan out?
Santasi.
Okay. So in this case, Santasi is going to recognize a financial asset, isn't it? All right. So we are going to do this for the Santasi company or PLC or public limited company. All right. So they say that you should discuss with suitable workings how the loan to the charitable organization should be dealt within the financial statements of Santasi for the year 31 May 20. So this is 1 year. June, the loan was made on June, and they are accounting for this one on 31 May. Okay. So you have to now tell them that they are giving the loan at a subsidized rate. But it is below the what? The actual interest rate or the market interest rate. In this case, this loan should, or this financial asset should initially be recognized at fair value. What constitutes the fair value? It is the present value of all the cash flows discounted at the current market interest rate. That's what the standard says. So you just have to tell them what the standard says and back your whatever you are saying with the computations. So what we have to do is that we first have to determine the fair value of this particular financial assets. Okay. Do we have any information about when the loan will be repaid?
In 3 years' time.
Okay. So the loan will be repaid in 3 years' time. So it means that in 3 years' time, they are going to receive the what? The 50 million. So the 50 million will be paid at the end of the third year. Okay. But this one, the company will be receiving an interest of how much every year? What will be the interest that they'll be receiving at the end of every year?
3%.
Okay, 3%. So we want to know the amount that constitute the 3%.
1.5.
1.5.
They will be receiving 1.5 every year. So the 1.5 for 3 years, that will give us an annuity. So what we do now is that these are the cash flows, the interest of 1.5 and 50 million at the end of the third year. So this is just accounted for as if we are doing the debt components of a hybrid instrument. That's how we do it. So we try to find the market value, the current market value of the instrument. So you can see that if you discount this at 6%, it's the same as we finding the debt component of a hybrid instrument. That's how we do. Okay, so let's go and do the workings for this. So that will be question 5, Santasi. Question 5 is about Santasi. Okay. So what we do is we have the years, we have the cash flow, we have the discount factor, and we have the present value. Should we use annuity or we do it one by one for the? So let's do it one by one since the years are not plenty. 1, 2, 3. Okay. So the cash flow will be the interest, which is 1.5. The discount factor will now be the what? The current interest rate, which is 6%. Okay. So what will be the discount factor for the first year? This will be 1.5. The last year will be 51.5, which is the interest plus the what? The repayment of the loan of 50 million. Okay, so let's find those figures first. Let's find the discount factor first. 6% for the first year.
0.943.
0.943. Okay. Second year is what?
0.890.
0.890. Okay. Last year, which is the third year,
0.840.
0.840. So let's find the present value first.
1.41.
1.41 for the first year. Okay.
1.34.
1.34. Okay. And the last one is
43.26.
43.26. Okay. So what will be the total value now?
46.01.
Okay, 46.01. So we just make it 46. Okay, 46.01 is the same as 46. Okay. So the fair value of the assets is 46 million. Okay. But the company is giving out what? 50 million. So currently there will be a loss of what? 4 million.
4 million.
Okay. So initially this should be recognized at what? At 46 million. Therefore, the company should debit financial assets. The company should debit a financial asset. Financial assets. You are giving 50 million out. The debit financial assets at 46. Debit profit or loss because they are going to have a loss of 4 million. Then they can credit their cash or bank because the money is given out, which will be 50 million. Okay. This is the initial recognition, we are doing this at the date of the issuance. So this is initial recognition. Okay. How should this be recognized in the books at the date of the transaction? That is what we call the initial recognition. Okay. What will be the subsequent recognition after you having 46 in your books? How are you going to what? Or what figure are you going to show at the reporting date? That is what we are calling the subsequent measurement. How are you going to what? During the year, how are you going to account for this at the end of the year? So the subsequent measurements will be, this will be carried at amortized cost, because the question didn't say that the company will be willing to what? To transfer the loan to a third party at any time. You can see that they are going to hold they are going to hold on onto the loan till the maturity date, which will be the repayment in 3 years' time. So this is what's going to be amortized cost. They are willing to receive the cash flows up to maturity. So the subsequent measurement will be amortized cost. And you can see that this is actually a debt instrument, financial asset through a debt instrument. So amortized cost. So the amortized cost, what is going to happen is that the company will have a fair value of 46 million. So they will have the fair value of 46 million. Then they will have their finance income. The finance income will now be calculated using the what? Using the market interest rates, which will be 0.06 times 46. What are we having?
2.76.
2.76. Then at the end of the year, the charitable organization are going to pay them what? 3% on the 50 million. And that will give us a reduction of 1.5. So let's look at what will be the difference.
47.26.
Okay, 47.26. So this will be the financial asset in their financial statement of or a statement of financial position. Okay, but the question says that the company has accounted for the interest received. The interest received was only the 1.5, which is what they have as the finance income. But in actual sense, it should be 2.6. So you can go to profit or loss. So what you do is that if you go to statement of profit or loss, you have to go and recognize the you have to go and recognize the SS. The SS will be 2.76 minus 1.5. Okay. Now, if you come to statement of financial position, they say that the company has reduced, they have reduced the, they have reduced the financial assets. They have reduced the financial asset with the interest. Okay. They have reduced the financial assets with the interest. This means that if you go to their books, they are going to be having 50 million minus 1.5. That's what they are going to have in their books. In their books, they are going to have 50 points, 1.5. That's what they are going to have. So in other words, they are going to be having 48.5. That's what they are going to have under the financial assets. But the actual value should be 47 points. So it will be 47.26. So you ask yourself, what value are you going to subtract from this to make it 47.26? So you just subtract. All right. So 48.5 minus 47.26. I'm having 1.24. So minus 1.24. That is all. But if you don't want to show the extracts, you can just explain to them how they have to account for this in the profit or loss, also the statement of financial position. If you don't want to show the extracts, that is all about this question. All right. That's all about this question. So you have to be very mindful when a loan is given or when an instrument is bought at a subsidized rate or at a rate lower than what the current market interest rates. You have to know how to account for that. Okay, let's look at impairment of financial assets. Okay, we know that impairment is not something that you should just stand up and be doing. Impairment of financial assets. Okay, basically the impairment of financial assets is only carried out on instruments carried through amortized cost. You see that through the amortized cost, what we do is that the instrument will be initially measured at what their fair value, which is their what nominal value minus any discount received, addition of any issuing cost. That is the end. We don't fair value at the end of every year. So what will happen is that you see that they are carrying the instrument at what cost, which is the initial cost. There is no fair value adjustment at the end of every year. So we are carrying the instrument at cost. It might happen that we are carrying this particular instrument at a value higher than the actual value. Okay, but we cannot just stand up and say we are going to see whether we are carrying the asset at a value higher than what its actual value, which is the recoverable amount. Okay, impairment is not something that you have to do every year. It's not based on the concept of matching. It's not something that you have to do. Okay, you are generating this amount of revenue and you are incurring this cost to generate the revenue. So you have to do the matching. It's not like depreciation that we are saying that we are using part of the asset to generate the revenue. So what portion of the asset was used to generate the revenue? This is not about depreciation. This is not about matching. This is purely about prudence. We just have to anticipate the loss. Not always should be making plan for the gain. So if we are sensing a danger, what do? We have to provide for it. That's what about the impairment. So you can only carry out an impairment on an asset when there is an indication that this asset is likely to be impaired. Okay. So you can give a loan to someone and there will be a hint that the person is in a financial what? Difficulties. So the person is going to default the what? The payment of the interest. So you should be receiving the interest at the end of every year. But the person, because of the financial difficulties that the person is facing, the person is going to be, the person will not pay the interest for the next 2 years. It is likely that the instrument will be impaired because the person is having financial difficulties. So the financial difficulties is an indicator of what? Impairment. Based on that, you can carry out an impairment test on your financial assets. I'm saying that the impairment is basically carried out on what? Financial asset carried through the amortized cost, because for this one, there's no fair value adjustment at the end of every year or at the end of each year. But instruments carried through other comprehensive income, you can see that at the end of every year, we look for the fair value. So it can be a reduction, it can be an increase. So if there is a reduction, the reduction is a loss, and that is the impairment loss, basically. If it is true profit or loss, you see that at the end of every year, we fair value the assets. So it can be a reduction or increase. If there's a reduction, that is basically representing the impairment loss, which we call the fair value loss. It's basically the impairment loss. But for instrument carried amortized cost, there is no fair value adjustment. So basically, we do the impairment on the what? On the instrument carried through amortized cost. Sometimes they can also give you instrument to profit or loss. They can also give you other comprehensive income. But we are also going to look at how to deal with those ones. But this instrument carried through other comprehensive income, their impairment test is automatic because of the fair value what? Adjustment. All right. So the person, you are giving a loan to the person can tell you that we cannot be able to pay. We cannot be able to pay the interest for this year. This is an indication that the instrument is likely to be impaired. So carry out an impairment test on it. All right. They can also be the companies facing what? Financial difficulties. So the person wants to what? Sometimes the person will say, we want to rearrange the what? The terms associated with the debts. So it can be restructuring. If there's restructuring issue, it is likely that the instrument will be what? Will be impaired. So you can only carry out an impairment test on the assets or on the financial asset where there is an indication that the financial asset is likely to be impaired. We don't just stand up and say we are testing for impairments, no. But for profit or loss, other comprehensive income, instruments carry under them, the impairment test is automatic at the end of every year because we do fair value measurement, fair value adjustment at the end of every year. Okay. If you are coming to an impairment text, okay, the standard suggests two issues. Sometimes they will say that the person is willing to default towards the interest payments. The person is willing to default the interest payments for 2 years or 3 years. So if there's a default in the interest payment or the default in the repayment of the distance of the loan, we say that that is likely to make the instrument to be impaired. All right. So if you are testing for impairment loss, you have to look at risks. We use risks to indicate which of the estimate we should use. Impairment is just, for this one, is just like a provision that we are making for the first time. So we use risks, the risk level associated with the financial asset. Those are the things that we use to estimate the impairment. So the standard says that where the risk associated with the instrument or the financial asset is low. So if the risk is low, we use the estimation for what? We use 12 months expected losses, where the risk associated with the instrument is low. We use 12 months expected losses. Okay. How do we determine the losses? The losses, they can give you the chances of the company defaulting in the payment of this one. So they will give you that over the 5 years, the company will be able to what? To pay only this amount of money with 2% likely of what? Or with 2% probability of default. So you have to calculate the chances of default. So what will happen is that they can give you the carrying value of the asset at 50 million, but they will tell you that the company will be able to pay only 10 million for the next 2 years or 3 years. So you have to calculate the present value of the amount that you are going to receive. So it can happen that the present value of the amount that you are going to receive is 35 million. It means that there's a likely that the company will not be paying 15 million. And this 15 million is what we call the default. So the possibility of the company not paying this one. So this is what they are not going to pay. So they can tell you that the possibility of not paying is 2%. So you calculate 2% on this, and that will represent the what? The expected losses for the 12 months. So you make a provision for that. Okay. If the risk has increased significantly, if the risk has increased significantly, risks, if the risk has increased significantly, risks increase significantly, okay. The standard says that we should use a lifetime expected losses. Lifetime expected losses. How do we determine the lifetime expected losses? The lifetime expected losses is the accumulation of the possible default over the lifetime of the instruments. So if the instrument will be redeemed at the end of 5 years, what will be the total expected losses up to the end of the 6 years? That is the lifetime expected losses. How do we do that? The question can give you the default for each year. So you calculate the default for each year. So maybe this is 2021. So the default is possible. The company is likely not to receive 15, but the likelihood of the company not receiving the 15 is 2%. So you calculate the 2% to determine your loss. They can also give you for 2022. You calculate your loss for 2022, 2023, 2024, 2025, and 2026. Then you now put all the possible losses together. If you add them, that represents your lifetime expected what? Losses. That is the losses for each year put together. That is the losses that you are likely to experience over the what? Over the life of the instrument. That is the lifetime expected losses. Okay. So if you are using risks, if the risk is low, we use 12-month expected losses. The question can give you the 12, or they can ask you to calculate it. If the risk has increased significantly, then we use a lifetime expected losses. Okay. These are all for the first time where there is an indication of possible impairment. Okay. The issue is if you are doing this one for the first time, if you are doing this for the first time, what we do is that we do this as a provision. We just account for it as a provision. Okay, because nothing is said that the instrument has actually been impaired. So we are just making a provision for possible losses. So it will be treated as a provision on each one. So what will happen is that this is a possible loss. So it will be taken to profit or loss as provision. Then in the balance sheet, we are going to show a liability, a non-current liability as a provision, but the assets will still be carried at 50 million. We don't subtract the possible losses from what? From the carrying value of the asset. So the asset will still be carried out, the carrying value, which is the 50 million. Then we treat the provision as a line item in the profit or loss account and also in the statement of financial position. That is for the first time. But the question can tell you that the asset is credit impaired. it means that the asset has actually impaired. Then in that case, the impairment should be taken away from the carrying value. So if you are doing the provision for the first time, your interest will still be carried, or your interest will still be charged on the what? On the carrying value or on the nominal value, like the way you should be doing it. How we charge the interest. We take the finance income from it and we take the coupon. Next year, we charge the interest on the net amount. So if you are doing the provision for the first time, the interest will still be carried or will still be calculated or will still be computed on the what? On the carrying value. That is for the first time. But if the asset is actually impaired, if the asset is credit impaired, that is the confirmation that the asset has actually been impaired, then what we do is that if the asset is credit impaired, then what we'll do is that the provisions, you have to see that the first time is a provision. So this can be 5 million. The next year, your provision is now 7 million. You have already charged 5 million. So you charge 2 million to profit or loss. It's just like a provision. But if the asset has actually impaired, or they will say that the asset is credit impaired, it means that the allowances now is actually what? Impairment. So we have to take it from what? Our carrying value of the assets. So assuming the carrying value of the assets is 50 million and our total provision up to date is 7 million, and they are saying that the asset is credit impaired. So what will happen is that in the statement of financial position, your financial asset will be shown as 50 million minus the 7 million, because the asset is actually impaired. So impairment should be taken away from the carrying value, and we'll be showing 43 million. So we are not going to have provision again. If the asset is credit impaired, it means that the interest income or the finance income will now be charged on the what? On the carrying value less the impairment. It will not be charged on the 50 million again, but it will be charged on the net amount, which is the carrying value less the impairment, because that particular portion of the financial asset will not be received again. So we charge the finance income on the what? On the net amount. Okay. Sometimes the question can give you the financial asset through different classifications. If it is through amortized cost, they can give you that the company is likely to receive this amount. If it is through amortized cost that you want to calculate the impairments or the losses, we use the original. They can give you some cash flows which you have to discount. They can give you, the company will not be able to receive this amount, but they will receive a cash flow for this number of years. So you have to discount them to the present value and compare to the carrying value. For the discounting, we use for amortized cost. Let me make it for amortized cost. For instrument carried through amortized cost, we use that for the discounting. For the discounting, we use the original effective interest rate as a discount factor. Original effective interest rate as a discount factor. Original effective interest rate as a discount factor. For profit or loss, we use the current market interest rate. So for instrument carried through profit or loss, we use the current market interest rates. We use the current market interest rate. For other comprehensive income, the discount factor will also be the original effective interest rate. So sometimes a question can give you effective interest rates. Okay, so sometimes the question can give you mostly for those who are doing corporate reporting, mostly for this one. Consolidated financial statement, they will give you a footnote that will be for this. So they'll give you that the company has a financial asset of this, and it is likely that the person is facing the financial difficulties, and the company will only receive a payment of this amount, this amount, this. So what you have to do is that you have to present value all those cash flows that they are going to receive in the future and compare with the carrying value now and see whether there's a reduction or not. If there's a reduction, that particular reduction will be treated as a loss. Okay, so that is all about that. If there is a possible default within 12 months, we use the 12-month expected losses. If the risk has increased significantly, we use the lifetime expected losses, and we know how to account for all of them. That is about the estimation should be based on what? A reasonable assumption. It should reflect all the possible issues surrounding the instrument. Okay, if you want to estimate the cash flows, you cannot go and be estimating the cash flow of an instrument for a company that is not credit or that is not facing a financial difficulties. So it should reflect all the relevant information in the market about that particular instrument. But this is an exam. They will give you those figures. Let's look at impairment of financial assets. Let's take one question before we go and come. All right. Okay, impairment of financial assets. Okay, let's take the first one.
On 1st June 20 excess, Mampon purchased 10 million of listed bonds at par and paid in cash. These bonds had been issued by Jamase, an entity operating in the video games industry. The bonds are due to be redeemed at a premium on the 1st May 20X9, with Mampon also receiving 5% interest annually in arrears. The effective interest rate on the bonds is 15%. Mampon often holds bonds until the redemption date, but will sell prior to maturity if investment with higher returns become available. Jamase's bonds were deemed to have a low credit risk at inception. On the 1st May 20X7, Mampon received the interest due on the bonds. However, there were wider concerns about the economic performance and financial stability of the video games industry. As a result, the quoted price of Mampon investment at the 1st May 20X7 was 9 million. Although a pricing model developed by the financial controller that relies on management estimates valued the holding at 9.5 million. Based on Jamase's strong working capital management and market optimism about the entity's forthcoming product, the financial controller of Mampon calculated the following expected credit losses for the Jamase bonds as at 1st May 20X7. 12 months credit losses, 0.2 million. Lifetime expected credit losses, 0.4 million. Required. Discard the accounting treatment of the Jamase bonds in the financial statement for the year ended 1st May 20X7. Your answer should explain the impact of the bonds in Mampon's statement of
All right, yeah. So this one, how are they classifying Mampon? How are they classifying the the financial assets? It will be classified through what? How would the instrument be classified? You can see that they have given a hint on the classification. If you look at the first paragraph, there's a hint on the classification there. This is a financial asset because the company is buying, so it's a financial asset through a debt instrument. And how are they classifying these particular instruments? Seniors, how are they going to classify it? Is it going to through profit or loss, amortized cost, or other comprehensive income?
Amortized cost.
Are you sure?
Because of the effective rate of interest. So it's between amortized cost and CI.
So it's they say to hold it until redemption date.
Mm-hmm. But
They're proud to maturity.
Okay.
That is
okay, Mapon often holds bonds until the redemption date, but will sell prior to maturity if investment with higher returns become available. Okay, we explained this one the last time that for amortized cost, the company is willing to hold the instrument up to maturity. They are not going to sell before the maturity. Okay, but for profit or loss, they will sell at any time. So they are holding the instrument for speculative or trading purposes. But for other comprehensive income, they are willing to hold it up to maturity, but they are also willing to sell before the maturity when higher opportunities or higher market, there's a higher market for the instrument. So they are indifferent whether to hold it or to sell it. But if there's no market, if there's no better market for the instruments, they can hold it up to maturity. But if there's a better market, they can sell it before the maturity. That is other comprehensive income. So let's look at the question here and see whether it will be other comprehensive income. Profit or loss is out. So whether it can be other comprehensive income or amortized cost. So looking at the explanation, which of them?
Comprehensive income. OCI, other comprehensive income.
comprehensive income.
So that will be other comprehensive income. Okay. If it is other comprehensive income, it's still okay. We still do the amortized cost. Discount received will be capitalized. The issue cost will be capitalized. And it will still be carried through the amortized cost. But the only difference is that at the end of each year, the instrument must be fair valued. That is the only difference. Okay. So let's come to this particular one, question one. Let's finish this one, then we go and come back. All right. So question one, which is the Mampon. Okay. So what will happen is that there is no issuing cost there. There is no discount received there. So what will happen is that they are saying that at the date of the purchase, there is no risk associated with what? With the instruments. So we can look for impairment at the date of the purchase. The initial recognition will still be at the fair value. So the initial recognition, we pick the fair value. So the initial recognition will be the fair value. Okay. The initial recognition will pick the fair value, and the fair value is 10 million. So this will be 10 million. So you debit. So you debit financial assets and you credit your cash or bank 10 million. Let's look at it. This is the initial recognition. The initial recognition to be fair value. So that will be debit your financial assets and you credit your cash or bank. So credit cash or bank. That will also be 10 million. Okay, let's come to the subsequent measurements. Subsequent measurement will be amortized cost. Amortized cost. So the subsequent measurement will be amortized cost. But at the end of the year, we fair value. That is the only difference. All right. So subsequent measurements. The subsequent measurement will be through amortized cost. What do? We look at the fair value of the asset, which is a balance at the end. That will be 10 million. Then we now find our finance income. Okay, our finance income will be the effective interest rate, which will be 15%. Is it 15%? Let's check. Okay, that will be 15% on the 10 million. What are we getting? times 10. That will give us 1.5. Am I correct? Okay.
Yes, senior.
Then we come to the coupon. The coupon will be the 5%, 0.05 times the 10. And that will give you 0.5. Okay. What are we getting?
$11.
Okay. That will give you 11. Okay. Let's go to the question, what they are saying about the fair value. Okay. On 31st May, Mapon received the interest on the bond. However, there were wider concerns about the okay. However, there were wider concerns about the economic performance and financial stability of the video games industry. So this can also be what's a possible indication of what's impairment. Okay. As a result, the quoted price of Mampon investment at 31 May 2x7 was what? 9 million. So the quoted price was 9 million. Okay. Although a pricing model developed by the financial controller that relies on management estimate value that the holding at 19.5 million. We are talking about instrument that you don't have any control over. So the instrument is being traded in a what? In an active market or in a particular market. And they are telling you that the price of the instrument on the market is 9 million. You are saying 9.5. So this is like a financial instrument where we pick what? The price in an active market. The active market is a quoted price. So if you are looking for financial or fair value measurement, the first one is that they say that you should go for the what? The price of the instrument in the active market. If there is no active market, then you can now look at the price in what? An advantageous what? Market, where the company can use their own pricing model and those kind of things. But this one, there is an active market price. The price is given in the market in which the instrument is being treated, which is 9 million. You are saying that based on your pricing model is 9.5. Don't say that you are going to pick the highest one, 9.5, because you want to be a rational investor. The 9.5, you are just deceiving yourself because you don't know things that are surrounded by the instrument. The instrument, the price of the instrument in the market in which the instrument is traded is 9 million. You are saying that you are using your own model to estimate the price is 9.5. Forget about the 9.5. We pick the price of the instrument in the active market, which is the quoted price, 9 million. Okay. So the fair value at the end is 9 million. Let's look at what they are saying about the losses here. Okay. So let's come here about what we are going to do. So let's come to the fair value at the end. The carrying value should be this one. So let's come to the fair value. The fair value is what? 9 million. Okay. The fair value is 9 million. What is the difference?
2 million.
Okay.
2 million.
There will be a difference of what? 2 million. And that will be a fair value loss. Okay. That will be a fair value loss. But let's come to, they are telling you something here. They are saying that Mapon calculated the following expected credit losses for the Jamasi bonds at 31 May 2x7. Why are we not using you can see that they are saying that the bonds we are still deemed to have a credit risk. The bonds are still deemed to have a credit risk. The bonds are still deemed to have a credit risk. The financial controller of Mampong calculate the following expected credit losses for the Jamasi bonds as at 31 May, this one. So if the bonds are, if the risks are low, we use the 12-month expected losses. Okay. So the 12-month expected losses. And we have the entire loss of what? 2 million. So someone will be asking, why are we not using the 0.2 as a loss rather than the 2 million? Why are we not using the 0.2 as a loss, but we are using 2 million as a loss? The instrument is carried at other comprehensive income, which at the end of every year you have to fair value and you get a fair value loss. Okay, but you can also decide that since they are saying that this one is low risk, the 2 million can be shared like this. The 2 million can be shared like this. So the 2 million over here, it means that 0.2 out of it is relating to the expected credit losses, which is possibly to be an impairment. Okay, so you can have this one as a fair value loss. So you can have a fair value loss of 1.8. Then you have provision for the losses, which is a 12 months to be 0.2 million. All right. So you can share this one. The loss is the actual loss, but this loss, we are expecting that there is a risk of what? 0.2 million. So 0.2 million of the 2 million is for the risk, and the 1.8 is actually through the fair value loss. So you can try to share it like this. That is all. So
what goes into the financial position?
The financial position, you make it 9.2 and treat the provision as 0.2. Okay, let me do the profit or loss first. You are going to have a finance income of 1.5. Okay, then you have the losses, the provision of the losses, which will be 0.2. Okay, then you can go to other comprehensive income, and have fair value loss of 1.8. Okay, this is supposed to be in bracket, it's a loss. Okay, if you come to statement of financial position, okay, you have the financial assets. Okay, the financial assets should just be the fair value, 9 million. But since you are having a credit loss, you do 9 plus 0.2, and that will be 9.2. Because the first time, we don't subtract the loss. Then you have provision under current liability of 0.2. So that if you subtract from this one, you just get your 9 million straightforward. All right. Nick, I hope you're okay now. All right. Yeah, Deborah.
Yeah.
Hello, sir.
Yes, yeah.
Yes, sir. So I realized that with this question, we didn't find any present value of the amount as in using the coupon rate. So I just wanted to understand with financial instruments, which part that we are supposed to find the present value, whereby we have to find the coupon and the interest before you come and get the current value before you go to the amortized cost.
That is where we have, if the loan is given at a subsidized rate. This is a transaction between two independent parties. The loan is given, everything is on commercial terms. So there is nothing like the 5% is the subsidized rate. No, there's nothing like that. So we only do that particular one when the financial asset is given out at a subsidized rate, like the one that we saw first. Okay. The loan was given at a rate lower than the market interest rate, which is a subsidized rate. But this one, everything is on commercial terms. The 5% is actually the market interest rate. The 15% is actually the effective interest rate on the market. So it is given on commercial terms, and there is nothing like a subsidized rate. So we don't do anything, we just go straight forward, like the normal way of doing it. Okay. Deborah, I hope we can move on.
Thank you. Yes.
Please go back to the, kindly go back to the board level.
Okay.
So, sir,
Yes, please.
the provision under the statement of financial position, is it under the financial assets?
No, it's
Or
on liability.
okay.
It should be under liability.
Yes, okay.
Okay. It should be current liability. All right, let's try to see whether we can solve additional one question. Then we move on. The second one is still I want to pick amortized cost. Okay, let's see whether this the question 4 is amortized cost. So let me see the question 4. Okay, let's pick the question 4.
On January 1, okay, required. Explain how this situation should be dealt with in Ngwa Limited statement of financial position for the year ended 31st December 20X1 and statement of financial position at 31st December 2021. Okay. On January 1, 2021, Ngwa Limited granted a loan of 500,000 to Teshi Limited at 20% per annum. Interest was payable annually in arrears, and the loan is repayable at a premium on 31st December 2023. The effective interest rate is 25%. Teshi Limited paid the interest due on 31st December 2021, but by then it was in such a financial difficulty that Ngwa Limited granted a concession. No further interest would be paid, and the principal would be repaid on the 31st December 2022 at 600,000. On the 1st December 2021, the amortized cost carrying amount of the loan was 525,000. The record explain how the situation will be dealt with in Nungwa's limited statement of profit and loss for the year ended, a statement of financial position as at 31st December 2021.
Okay, I have problem with this one. If so, we look at it from the two perspectives. The principal repayment should be done on the 31 December 2023. That is where the loan will be repayable. That's why they're going to pay the loan. So it should not be 2022, it should be 2023 because I didn't read through. But we are going to do it if it is 2022, what will be the accounting treatment? If it is 2023, what will be the accounting treatment? But it should actually be our 2023. Okay. So the Nungua granted a loan of this to Teshi at what? So this is the coupon rate. Okay. And this is the effective interest rate. This is the effective interest rate. Okay, this is carried through amortized cost. This is carried through amortized what? Cost. Okay, the interest for this particular year has been paid, but the company was in a financial difficulty that Nugua granted a concession. If you granted a concession to someone that is owing you, it is likely that the instruments will be impaired. So concession is part of what? The indicators of the impairment. Default in interest payments for more than a year is also an indicator for an impairment of financial assets. Okay, so no further interest will be payable, and the principal will be repaid on 31st December 2023. That is the repayment date. Okay, so we take it from 2023 and also 2024. So what we are going to do is that from January to this year, at the date, the initial recognition will be financial assets at 500,000. So you charge your interest, your finance income, 25%, your coupon, subtract it, and you have your amount. So let's do that first before we come to how we look for the initial recognition will be the fair value. So initial recognition will be debit financial assets of 500,000. Then you credit cash or bank 500,000. Okay. Then let's come to the subsequent measurements. The subsequent measurement will be amortized cost. This is through amortized cost. Okay. So we have the fair value at the date of transaction, which is 500,000. Then we charge our finance income 0.25 times 500,000. What are we getting?
125.
125. So our coupon, which is the nominal interest, will be 0.2 times 500,000. How much are we getting?
100,000.
100,000. Okay. So this will be left with 525,000. Okay, 525,000, which the question is telling you. Okay. Okay, a minute. Okay. All right. So now they are saying that the company is not going to be receiving any what? The company is not going to be receiving any the company is not going to be receiving any further payment again, but the principal will be received. The principal will be paid on 31 December 20, this should be 2023. Okay, this should be 2023, not 2022. Okay, will be repaid on 31 December 2023 at 600,000. So it means that for the year 2022, no interest will be received. 2023, no interest will be received. By the end of 2023, we are going to receive what? 600,000. What we have to do is that, okay, our current or our present value of the instrument is now 525,000. Okay, so the amount that we are going to receive in 2 years' time, because today is 31st December 2021. So if you are going to receive this one on 31st December 2023, that is 2 years from now. So this is the amount that we are going to receive in 2 years' time. And this is the current value of the instrument. We want to know the current market value of the 600,000. If you should give us the 600,000 today, what is the value? So we find the present value of the 600,000. Then we compare with the current carrying value, which is the 520,000. But the question is, what is the interest rate that we are going to use? This is true amortized cost. I said that you have to use the original effective interest rates. So you find the present value of the amount that you are going to receive. You find the present value of the amount that you are going to receive, and you compare with this and look for the loss. Or let's find that one. Then I will say something again. Okay. So let's look at the present value of the cash flow. So that present value will give us the present value of the repayments will be calculated as 600,000 divided by 1.25 exponent 2. Okay, this can also be calculated as the 1 over 1.25 exponent 2. It's just a discount factor, so straightforward, we can calculate it like that. What are we getting?
384,000.
384,000. Okay. 384,000. Okay. That is the payment to be done at the end of the third year. Okay. So we will come to the second year too, if they are going to pay at the end of 2022, we also calculate that and look at the options. Okay, look at this. What is the amount that we should currently be receiving? It's 525,000, isn't it?
Yes.
Yes.
Okay. But the present value of the amount that we'll be receiving in the future is 384. What is happening?
There's impairment.
Okay.
Or there's loss.
There's a loss of what?
141,000.
141,000. Okay. This loss will be created as a provision because the question didn't say that the instrument is what? Credit impaired. So we are going to create a provision of 141,000. We are going to create a provision of 141,000. Okay. But let's assume that this one, the question can also give you the possibility of default. So it means that the company will not be able to pay 141,000, but they can give you the possibility of the default, which they will give you a rate. So they can say that the company will only pay the interest, the company will pay only the principal of this amount at the end of 2023. Okay, so it means that you are going to be having 384,000. So there's a possibility of a loss of 141,000. Okay, if this is the case, what will happen is you will look for, this is the amount that you are not going to be paying. but the possibility of you not paying this amount is 5%. So you find a possibility, which is the expected loss. So you just apply 5% on this. If it is 20,000, the 20,000 will now become the what? The possible loss, which will be the provision. But this one, they haven't given you the percentage of the what? The loss, the possibility of the company not paying this. They haven't given you that particular rate. So if that rate is given to you, then you have to, if that rate is given to you, then you have to apply it on this one to get the what, the possible loss. But this one, since no rate is given, it means that it is 100% that these people will not be able to pay this portion of the amount. All right. So 141,000 will be a loss. Then you now reduce your figure, this figure. You now reduce this figure to 384 by subtracting the 141,000 from it. So subsequently, your income, your finance income will be charged on 384,000. So you charge your finance income on 384,000 subsequently, but there will not be any coupon payment because the question says that no further interest will be paid. So you'll not be receiving any coupon. So you just be charging your finance income on this. And for the 2 years, you accumulate this figure to your 600,000. So you have the provision, which is a loss in the profit or loss, but this provision should be net against the current amount straightforward to make it what? 384,000. All right. Let's assume that this is the payment, the repayment will be done at the end of 2022. So that will be only 1 year from now. So the repayment, let's look at the present value and look at how we account for that one too. That one will be 600,000 divided by 1.25 exponent 1. What are we getting?
$480,000.
Okay, 480,000. So this is the amount that we are going to be receiving. We compare against the carrying value. So what will be the loss? $525,000 minus 480,000. So you account for the 45,000 as a loss in the statement of profit or loss, and the 45,000 should be net against the 525,000 to bring it to what? 480. So subsequently, your finance income. So if you are doing for 2022, you have your fair value to be 480,000. Then you have your finance income. Your finance income will be 45,000. Okay, which is the 25% on the 45,000. And this will give you, no, that will not be 45,000. Let's calculate that and see. I'm sure that will be 120,000. 25% on the 480. Would that be 120,000?
Yes.
Okay. So that your finance income, if we add it to, there will not be any interest. So you not receive any coupon. So if you add it to, then you now receive your 600,000 at the end of what? The December 2022. But if you come to this, the first one, your 2022 interest will be calculated like this. You have your fair value of 384,000. Okay. Then your finance income will be 25% on that. Okay. What will be the figure? 25% on this.
96,000.
Okay, 96,000. The question says there will not be any interest payments. So no coupon will come. So let's add a 2. So 2023,
480.
480. Okay. So 2023, you have your fair value of 480. Then you have your finance income of 120,000. So at the end of the day, you have your 600,000, which will be paid to you at the end of the 2023. There will not be any coupon because no interest will be paid. This is all about the financial asset, impairment of financial assets. So you just have to know that if the asset is what, if the risk associated is very low, we use 12-month expected losses. If it is significant, we use what, lifetime. And they can also give you the question. They can give you so many questions on the impairment of financial assets. So maybe during normal class, we'll be able to solve more. Okay, we'll be able to solve more on this particular one. So I'll give us. We are going to take 10 minutes break. We go and come. All right. So I'll see you guys after 10 minutes.